Money Talks, sponsored by Lexus of Las Vegas and Lexus of Henderson.
The coronavirus pandemic continues and a record number of Americans have filed for unemployment. Yet April was one of the best months on Wall Street in decades, leaving many confused about where the economy is headed. I spoke with local financial professional Brad Zucker from Safe Money Advisors to discuss what all of this means for your money.
Brad, where does the market stand right now?
So the market had a major rebound in April off of their March lows. In April, the Dow and the S&P 500 had their best monthly gain since 1987. And many experts credit that rebound based on many states reopening their businesses and possible COVID-19 treatments on the horizon.
You mentioned COVID-19. How has the coronavirus impacted the stock market?
Well, the new numbers coming from the federal government show that the U.S. economy shrank at an annual rate of 4.8% in the first quarter. And as the pandemic spread across the country, many businesses shut down and a recession ended the longest expansion on record. Now, many experts are warning that the numbers coming into the next quarter ending in June are going to be far worse because of many people finding themselves out of work. And if this holds true, this could be 4 times greater than the worst quarterly contraction set on record in 1958.
And our retirement savings have also been impacted by the coronavirus. So how closely should we be watching our 401ks?
Well, we've got a lot of roller coaster rides on Wall Street because of uncertainty. But it's important that we continue to make contributions directly from our paychecks into those 401ks, which balances got hammered by double-digit losses in the first quarter. So I always recommend 10 to 15% of your paycheck directly into your 401k. If that's not feasible, at least put enough to get the company match. Those that stay on the course will be buying shares at discounted prices, which could benefit them in the long term.
And a question for investors now, what should they be doing with their money?
Well, it starts with creating a plan, a written income plan that includes Social Security, healthcare, income planning, and tax strategies. And it outlines your specific goals and the paths to achieve them. Now, everybody's situation is unique, so you should sit down with your financial advisor, because our clients that are in or near retirement are looking to reduce taxes, increase their income, and lower market risk exposure.
Is there anything else that people should do, especially investors?
You know, the fear of a recession is not stopping investors from putting money into the stock market. They're watching their account balances go up, and they don't want to miss out on opportunities. So make sure your portfolios are diversified and you have risk based on your age and how close you are to retirement. Use the rule of 100. Subtract your age from the number 100. That will give you the figure as to how much money should be in riskier investments like stocks. But that's just a beginning. You should sit down with your advisor and build a portfolio that's based on your age and risk tolerance.
All right. As always, we appreciate your advice, Brad. We've put all of this in ktnv.com. Thank you so much for your time, and we'll be right back.